What if the AI boom has created a company that most investors still don't fully understand? A company that doesn't build the most famous AI chips, doesn't create the most popular AI chatbot, and doesn't have the brand recognition of Nvidia or Microsoft. Yet it is sitting directly underneath the AI revolution, providing the computing power that some of the world's biggest AI companies desperately need. That company is CoreWeave, and after its latest results, the story just became much bigger. Revenue more than doubled. Its backlog reached roughly $104 billion. And new customer commitments pushed even higher, but here's the catch. CoreWeave is also spending enormous amounts of money, carrying substantial debt, and still reporting a GAAP net loss. So the billion-dollar question is simple. Is CoreWeave stock still worth buying in 2026, or has the AI opportunity already been priced into CRWV? Let's find out. 1. What exactly is CoreWeave? CoreWeave is basically an AI-focused cloud infrastructure company. But that description doesn't fully explain why investors are paying attention. Think about artificial intelligence for a moment. Every time someone trains a massive AI model, runs an AI application, or asks an advanced AI system to generate something, enormous computing power is required. That computing power comes largely from specialized GPUs. And those GPUs need data centers, networking, cooling, storage, software, electricity, and a massive amount of infrastructure. CoreWeave provides that infrastructure. Instead of companies having to build everything themselves, they can rent access to powerful computing capacity from CoreWeave. And that makes CoreWeave one of the companies selling the infrastructure behind the AI revolution. That is the first reason this stock is so interesting. 2. The AI infrastructure opportunity. The AI boom isn't slowing down simply because investors have already heard about artificial intelligence 1,000 times. The technology is becoming more demanding. AI models are becoming larger. AI agents are becoming more sophisticated. Companies are integrating AI into software, healthcare, finance, robotics, manufacturing, and countless other industries. All of that requires computing power, and this is where CoreWeave's opportunity becomes enormous. The company isn't trying to predict which AI application will become the winner. Instead, CoreWeave can potentially benefit from the overall demand for AI computing. It's similar to selling picks and shovels during a gold rush. You don't necessarily need to know which miner discovers the gold. You need enough miners to keep buying your equipment. And CoreWeave is trying to become one of the major infrastructure providers for this new AI economy. 3. The number that changes the story. Now let's talk about the number that really caught my attention. CoreWeave reported second quarter 2026 revenue of approximately $2.58 billion. That's more than double the $1.21 billion reported in the same quarter a year earlier. But revenue growth isn't even the most eye-catching number. CoreWeave's revenue backlog reached approximately $104 billion at the end of June. And the company said it added more than $25 billion in additional customer commitments early in the third quarter. That gives investors something extremely valuable: visibility. The company isn't simply hoping that AI demand appears next year. It already has major customer commitments that could translate into future revenue as infrastructure is delivered and services become available. And that changes the investment story. 4. Who is actually buying CoreWeave's capacity? This is another reason CRWV deserves attention. CoreWeave has relationships across the AI ecosystem, including major technology companies, AI labs, enterprises, and cloud customers. The company has expanded relationships with names such as Meta, OpenAI, Anthropic, and other major AI-focused organizations. That matters because these aren't ordinary customers. The biggest AI developers require enormous amounts of computing capacity. If CoreWeave can become a trusted infrastructure partner for these companies, it could potentially benefit from AI spending for years. And that creates a very interesting dynamic. The more AI applications grow, the more computing capacity they may need. The more capacity they need, the more infrastructure companies like CoreWeave can potentially sell. That is the bull case in one sentence. AI growth creates computing demand, and CoreWeave wants to capture that demand. 5. But here comes the problem. Now we reach the part that could completely change your opinion about CRWV. CoreWeave is spending enormous amounts of money to build this infrastructure. The company increased its 2026 capital spending outlook to approximately $35 to $39 billion. That is an extraordinary amount of spending. Why? Because CoreWeave needs data centers. It needs GPUs. It needs networking equipment. It needs power. It needs cooling systems. And it needs all of that capacity available quickly enough to satisfy customer contracts. This creates a fascinating paradox. The stronger AI demand becomes, the more CoreWeave needs to spend. And the more it spends, the more financing and execution become important. So explosive growth doesn't automatically mean explosive profits. That distinction is critical. 6. The debt problem. This is probably the biggest risk investors should understand before buying CoreWeave stock. Building massive AI infrastructure requires massive amounts of capital. CoreWeave has used debt and other financing arrangements to fund that expansion. And debt creates a very different risk profile from a traditional software company. Imagine a software company growing rapidly. Its costs might increase, but it doesn't necessarily need to build billions of dollars of physical infrastructure. CoreWeave is different. It needs physical data centers and expensive computing equipment. And that means interest expense matters. In the second quarter, CoreWeave reported net interest expense of roughly $640 million. At the same time, the company reported a GAAP net loss of approximately $567 million. So investors shouldn't look at the enormous backlog and assume that the company is already printing cash. The opportunity is huge, but so is the financial commitment required to capture it. 7. Here's why bulls aren't worried yet. CoreWeave bulls will tell you that looking only at today's losses misses the bigger picture. And there is some logic to that argument. The company is building infrastructure for a market that is expanding extremely quickly. Its adjusted EBITDA in the second quarter reached approximately $1.51 billion, with a 59% adjusted EBITDA margin. That's a very different picture from the GAAP net loss. The argument is that as CoreWeave scales its infrastructure and activates more capacity, its existing investments could generate much more revenue. In other words, today's massive spending could potentially create tomorrow's massive cash generation. If that happens, the current losses could eventually look like the cost of building an enormous AI infrastructure platform. That's the dream investors are buying. But dreams have to become numbers. 8. The biggest risk besides debt. Execution. This might actually be more important than the debt itself. CoreWeave can have billions of dollars in customer commitments. But it still has to deliver the infrastructure. That means building data centers, securing electricity, installing GPUs, managing supply chains, activating capacity, and doing all of this on schedule. If projects are delayed, revenue recognition can also be delayed. And customers may have flexibility around deployment timing. So the challenge isn't simply getting contracts. It's turning those contracts into operating infrastructure and then into actual revenue and cash flow. That is where CoreWeave's management team will be tested. 9. Could Nvidia help CoreWeave? Here's another interesting part of the story. Nvidia isn't simply a supplier in the broader CoreWeave ecosystem. Nvidia has also invested in CoreWeave and has a significant strategic relationship with the company. That creates an interesting alignment. Nvidia wants more AI infrastructure in the world because more infrastructure ultimately means more demand for its GPUs. CoreWeave wants those GPUs because its business depends on providing AI computing capacity. And AI companies want access to that computing capacity. So you have a potentially powerful ecosystem. Nvidia provides the technology. CoreWeave provides the infrastructure. AI companies provide the demand. And customers ultimately pay for the computing. That doesn't make CoreWeave risk-free. But it does explain why investors see strategic importance in the company. 10. So, is CRWV still worth buying in 2026? This is where I would separate the company from the stock. CoreWeave is clearly one of the most interesting AI infrastructure stories in the market. The revenue growth is extraordinary. The backlog is enormous. Customer demand appears strong, and the AI computing market could continue expanding for years. But CRWV is also a high-risk investment. The company is spending tens of billions on infrastructure. Debt and interest expense are significant. GAAP profitability remains a problem. Execution has to be nearly flawless, and the stock can be extremely volatile. That means this isn't the kind of company where I would blindly buy simply because AI is popular. The valuation matters enormously. If the market already assumes years of spectacular growth, even strong earnings might not be enough to keep the stock rising. But if CoreWeave keeps growing faster than expectations, successfully activates its infrastructure, manages its debt, and eventually converts its enormous backlog into sustainable cash flow, the upside could be substantial. 11. What should investors watch next? If you're considering CRWV, don't just watch the stock price. Watch the backlog. Watch revenue growth. Watch capital spending. Watch debt. Watch interest expense. Watch data center construction and deployment. And most importantly, watch whether the company is moving closer to sustainable profitability. Because that's the moment when the story could change. Right now, investors are largely paying for future potential. Eventually, that potential needs to become consistent financial performance. And if it does, CoreWeave could become one of the most important infrastructure companies in the AI economy. 12. My final take. So, is CoreWeave stock still worth buying in 2026? I think CRWV deserves serious attention, but I would classify it as a high-risk, high-reward AI infrastructure investment. The bull case is incredibly powerful. AI demand continues exploding. CoreWeave's revenue is growing at extraordinary rates. Its backlog is enormous, and some of the world's most important AI companies are becoming customers. But the bear case is equally important: huge capital spending, heavy financing requirements, significant interest expense, GAAP losses, and enormous execution risk. That's why I wouldn't ask only, can CoreWeave become bigger? It almost certainly can. The much harder question is, can CoreWeave become highly profitable after spending so much money to build that growth? If the answer is yes, investors may look back at 2026 as the early stage of something much bigger. If the answer is no, the enormous backlog may not be enough to protect shareholders from disappointing returns. And that's what makes CoreWeave so fascinating. It's not simply another AI stock. It's a bet on the infrastructure underneath the entire AI revolution. And if artificial intelligence becomes as important as many investors believe, the companies providing the computing power could become just as important as the companies building the AI applications themselves. The opportunity is enormous. The risks are enormous. And for CRWV investors, the next few years could determine which side of that equation wins.